It's over. Or at least, that's what it feels like when you see the numbers flash across the screen. Banks tapping the Federal Reserve for $17 billion in emergency liquidity, right as silver shorts begin to unwind in ways most people didn't think were possible. And the real question isn't whether $17 billion is a lot of money in a system that now counts everything in trillions. The real question is this: why does this keep happening at moments when confidence is already fragile? And why does silver, of all things, keep showing up at the center of these stress points? Welcome to Cash Historian. If you're new here, this is where we slow the story down, strip away the headlines, and follow the money all the way back to its roots. For decades, we've been told that modern banking is resilient, diversified, and protected by layers of regulation designed after the last crisis to make sure the next one never happens. Stress tests, capital buffers, liquidity ratios, emergency facilities. On paper, it all looks airtight. So when reports emerge that banks are once again leaning on the Fed's backstop, even for a relatively modest sum by today's standards, it feels like a contradiction. If everything is stable, why the need for the safety net? And if it's not stable, why does the stress keep showing up first in places most people don't watch, like the silver market? To understand why this moment matters, you have to let go of a comfortable assumption. The assumption that silver is just a speculative sideshow, a volatile cousin of gold that spikes and crashes without consequence. That assumption is one of the biggest myths in modern finance. Silver isn't just an investment. It's money's shadow, it's industry's bloodstream. And at critical moments in history, it has exposed weaknesses that were already there, long before anyone admitted them. Silver has always occupied an uncomfortable position in the financial system. For thousands of years, it was everyday money. Gold settled empires, silver settled daily life. Wages, taxes, trade, and trust all flowed through silver coins. In the United States, that legacy was written directly into law. The Coinage Act of 1792 defined the dollar in terms of both gold and silver, embedding bimetallism into the foundation of the American monetary system. Canada followed a similar metallic tradition through British influence. For generations, money was tangible, finite, and anchored to something that couldn't be created at will. That constraint became a problem as governments grew larger and wars became more expensive. By the 20th century, the world was straining against metallic limits. Gold was pulled from circulation first, most dramatically in 1933. Silver held on longer, but its fate was sealed by the 1960s. As inflation rose and coinage debasement became politically unavoidable, silver was removed from U.S. and Canadian coins. Officially, this was modernization. In reality, it was a break from discipline. But silver didn't disappear. It transformed. As money retreated into paper and then into digits, silver became an industrial backbone. Electronics, medicine, chemical catalysts, and eventually energy technologies all came to rely on it. Unlike gold, which mostly sits idle in vaults, silver gets consumed. Once it's embedded in a circuit board or a solar cell, it rarely comes back. That single fact changes everything. As the financial system became more complex, banks found ways to abstract silver away from its physical reality. Futures contracts, options, swaps, and unallocated accounts allowed institutions to trade exposure to silver without ever handling the metal itself. This worked as long as confidence held and physical demand didn't overwhelm paper promises. It was a familiar model, fractional reserve banking, but applied to bullion. For years, it looked stable. Prices stayed relatively subdued. Volatility came and went. Most people stopped paying attention. Silver became the forgotten metal, overshadowed by equities, real estate, and eventually crypto. But under the surface, leverage was building. Claims on silver multiplied far faster than the available physical supply. And just like every other leverage system in history, it was stable. Until it wasn't. The first major crack came not from silver itself, but from the broader financial system. The 2008 crisis shattered the illusion that sophisticated risk management could eliminate systemic danger. Banks that were supposedly insulated from failure collapsed or required extraordinary intervention. In the United States, the Federal Reserve opened emergency facilities that rewrote the rulebook. In Canada, the system held together better, but only because of implicit guarantees and a housing boom that masked deeper vulnerabilities. In the aftermath, regulators focused on derivatives and leverage. This is where silver quietly entered a new phase. Precious metals positions, especially those tied to physical delivery, were no longer treated as harmless. Under updated banking regulations, including Basel III standards implemented through the 2010s and early 2020s, unallocated precious metals became expensive for banks to hold. Capital requirements rose. Balance sheet penalties increased. What had once been easy profit turned into regulatory friction. Banks responded rationally. They reduced exposure. They exited certain market-making activities. Many stopped selling physical silver to retail clients altogether. There was no dramatic announcement. No headline that said banks are banned from selling silver. But functionally, the effect was the same. The intermediaries that once provided liquidity stepped back. At the same time, the world changed in a way that few people fully appreciated. The energy transition turned silver from a niche industrial input into a strategic resource. Solar panels require silver for their conductivity. Electric vehicles use silver in power management systems. Grid upgrades, medical technology, and advanced electronics all depend on it. Demand wasn't speculative, it was structural. Mining couldn't keep up. Most silver isn't mined on its own. It's a byproduct of copper, lead, and zinc production. When base metal investment slows or environmental regulations tighten, silver supply suffers. New mines take years, often decades, to permit and develop. Recycling helps at the margins, but it's expensive and slow. By the early 2020s, the gap between demand and supply was no longer theoretical. Inventories were shrinking. This is where the story starts to converge with banking stress. As physical markets tightened, the paper-silver market became more fragile. The ratio of paper claims to physical metal grew increasingly uncomfortable. For banks and large traders, this wasn't just a price risk. It was a delivery risk. If too many counterparties demanded physical settlement at once, the system would strain. Fast forward to the present moment. Interest rates have risen sharply since 2022, exposing vulnerabilities across the financial system. In the United States, federal debt has pushed beyond $35 trillion. Interest costs now rival major budget categories. Debt ceiling fights have become routine. In Canada, household debt remains among the highest in the developed world, with housing markets in Toronto and Vancouver still stretched relative to incomes despite cooling prices. Against this backdrop, even small shocks matter. Liquidity is no longer abundant. Risk-free no longer feels risk-free. When reports surface that banks have tapped Federal Reserve liquidity facilities for billions of dollars, it's not necessarily a sign of imminent collapse, but it is a signal. A signal that balance sheets are under pressure. A signal that confidence is conditional. Now layer silver on top of that. As prices rise and volatility increases, short positions become dangerous. A short sale assumes you can buy back the asset later at a lower price with ample liquidity. That assumption breaks down when physical availability tightens and paper markets thin out. If you're short silver in size and the market moves against you, losses can escalate quickly. This is where the headline number matters less than the mechanism. $17 billion isn't about saving silver traders. It's about stabilizing the system around them. Emergency liquidity doesn't flow because one market misbehaves. It flows because interconnected balance sheets can't absorb stress without it. Historically, this pattern is familiar. In the late 1970s, silver surged alongside inflation. The Hunt brothers' attempt to corner the market became a cautionary tale. But the deeper story was about leverage and confidence. When silver collapsed in 1980, it wasn't just speculators who suffered. Banks, exchanges, and governments scrambled to maintain order. Rules were changed midstream. Liquidity was provided where needed. Stability was preserved, but trust was damaged. The irony is that gold behaved differently. Gold held its status as the ultimate reserve asset. Central banks continued to hold it. Institutions treated it as a long-term hedge. Silver, by contrast, was left to the margins. Affordable, industrial, volatile, the people's metal. That divide still exists today. Gold sits quietly in ETFs and central bank vaults. Silver oscillates between investment and necessity, exposing stress when systems are tight. So what happens when banks, constrained by regulation and risk, no longer want to intermediate silver markets just as demand accelerates? Liquidity dries up, price moves become sharper, short positions become more dangerous, and any stress in the broader financial system amplifies the effect. This is why the phrase, "banks tap the Fed," should never be dismissed as routine. The Federal Reserve exists to provide liquidity when markets can't. Every time it's used, it tells you something about underlying fragility. The same is true in Canada, where the Bank of Canada has its own emergency tools, even if they're used more quietly. And this brings us to the failed fixes. Policymakers often assume that price signals will solve everything. Higher prices will bring more supply. Volatility will attract liquidity. In theory, that's true. In practice, it takes time. Mining doesn't respond overnight. Recycling doesn't scale instantly. And confidence, once shaken, doesn't return easily. Another proposed fix is substitution. Find alternatives to silver in industrial applications. Engineers are trying, but physics imposes limits. Silver's conductivity and reliability are hard to replace without sacrificing efficiency. In an energy transition already struggling with cost overruns, compromises are expensive. Meanwhile, financial markets continue to paper over physical constraints. Derivatives multiply. Leverage persists. And central banks stand ready to intervene when stress spills over. This isn't a conspiracy, it's a pattern. Stability is maintained by absorbing shocks, not by eliminating their causes. Now zoom out. What does this mean for someone watching from the United States or Canada? It means the era of easy assumptions is ending. Debt levels are high. Demographics are unfavorable. Entitlement programs like Social Security face long-term funding gaps. In Canada, housing affordability remains a structural challenge. Central banks are trapped between fighting inflation and supporting growth. In that environment, assets that sit at the intersection of money and necessity behave differently. Silver isn't just a hedge, it's a signal. When it tightens, it tells you something about supply chains, energy policy, and financial leverage all at once. So let's bring this together with 3 clear takeaways. First, banks tapping central bank liquidity is not a sign of strength. It's a sign that the system still depends on emergency support when stress appears. The amounts may seem small relative to the total system, but the mechanism matters. Second, silver's volatility is not just speculation. It reflects a structural imbalance between growing industrial demand and constrained supply, amplified by a financial system that prefers paper claims to physical reality. Third, when intermediaries step back from a market, it's rarely because the asset is irrelevant. It's because the risk of promising liquidity has become too high. Here's the question I want you to think about. If silver, a relatively small market by dollar value, can expose these pressures, what happens when stress hits larger, more central markets at the same time? If you found value in this deep dive into money, debt, and the hidden mechanics of the financial system, you're exactly where you should be. This is Cash Historian. Subscribe to Cash Historian, turn on the bell so you don't miss what's coming next, and share this with someone who still believes the system no longer needs a safety net. Leave a comment below with your take on whether silver is warning us about something bigger.